Good morning, everybody. It is Monday, August 18th, and August options expired on Friday. I'm a little under the weather right now, so I'm not going to put on the camera. I haven't been able to print my hair and get over the fact that I probably didn't eat enough broccoli and salmon this weekend. All right, where are we at? Last Wednesday, we did our monthly macro call. And I think it's time, if you haven't been really catching up on some of these videos, that you do that. So go ahead to the Investing with Kirk Spano site, Investing 2020s, and listen to this webinar, The Bull's Last Puff on Cigar. Now, I don't know if they have puffs until the end of the year. There are very big corporate buybacks going on right now, and those are fairly concentrated, about 30 or 40 companies. So that might hold the index levels up. But as of today, it looks like they're starting to get choppy. I don't know if that is a momentary phenomena or if we're going to get follow through from whatever it is Chairman Powell says this week. So if Jackson Hole is sounding like, hey, things aren't that bad, but I'm going to cut anyway, market probably goes up. If Powell does his tightrope routine and you can't tell what he's saying, markets probably go down or don't move. I would bet on Powell doing the tightrope routine. I don't think he's going to give away very much, but we'll see. My opinion is that he should say that they're leaning towards cutting rates. I don't know if that's what he will say. My reasons for rates coming down are different than President Trump's. I think that unemployment is set to tick higher meaningfully. If you follow the layoff numbers, the new layoffs, the planned layoffs, you can see that they're starting to rise. One of the weird problems is that even though employment hiring has flattened out, the layoffs haven't surged yet. But people who are out of work are staying on unemployment longer. And historically, that has meant that there hasn't been work out there. I think that there is a more psychological aspect. I think people are just saying, hey, they're going to give me unemployment, which is basically a partially paid vacation. I'm going to have a partially paid vacation. I think a lot of people who can afford to do that, and maybe they really can't afford it, but they do it anyway. I think there's a lot of people playing out the string on the unemployment checks. And I think there's a lot of people, and I have some subjective evidence of this, that really hold out for the perfect job. They really want to have a hybrid job where they're working from home 3 or 4 days a week, doing exactly what they want for a lot of money and great benefits. Hey, great. But I don't think there's really a lot of those jobs out there. What I think is out there, and all the data suggests this, at least while we can trust the data, is that there are a lot of service jobs out there that are unfilled, a lot of them. And the healthcare industry is probably at the epicenter of that. As doctors and nurses retire, the boomers retire, and we probably have about 5 years left of boomers in the workforce in any large numbers. That's going to get worse. The fact that we don't have a great educational system anymore, especially not one that's affordable. I mean, if you can afford it, you can get educated and learn skills. But I went to college for $3,000 a year. I mean, you add a zero, it's 10 times. In 30 years, it's 10x the cost of education. And we have defunded public education in a weird way. We've done it while spending more money. And I say defund because I have watched the deterioration of education in America, public education in particular, since the 80s. This is when it started. And I think it's having a profound impact today on the labor force. We've talked about the massive mismatches between skills and the jobs available for a decade, and it has just gotten worse. There are 6 or 7 million jobs available out there, and there are 6 or 7 million people that need jobs, but they can't do those jobs because they don't have the training, they don't have the education, many circumstances, they don't have the motivation. So you have this relatively large mismatch, and I'm not sure what fixes that other than making colleges and junior colleges and tech schools almost free. A little skin in the game, but almost free. And we need to do something about medical school. We have to find a way to encourage people to go into medicine and engineering at the graduate level. And I think that means just like we favor certain industries with tax breaks and tax incentives, credits, subsidies, I think we need to make grad school for engineers and people who would be doctors or even physician's assistants. I'm not positive you can do that at the undergrad level. I'm not sure exactly how that works. We need to make that cheap. Not free, but cheap. Or at least tie it all to forgivable loans. Some sort of massive tax deduction. Like every dollar you put towards your loan is pre-tax. Take it right off your income. I'm not sure exactly the mechanics, but we are so far away from doing any of those things that this labor mismatch is going to last a long time. Robotics is going to become more and more important because the corporations will adapt far sooner than the government. And the corporations just look at it as, hey, how do we increase our margins? Knowing that revenues are only going up basically with inflation. And that's true. For about 90% of the economy, revenues really haven't grown for better part of 6-7 years. And that's probably a long-term trend, again, unless we allow a lot of immigration. So while the next few years look like it's going to be tight on immigration, as those last boomers leave the workforce, we're going to have to figure it out. Between now and figuring it out, I think is the choppy period in the economy. I think we probably get a double dip recession soon, and then again by decade end or around decade end. I think they both come with quantitative easing. I think you may see kind of a W shape emerge in the stock market from here. Think of the letter W right now. I think we're at the top of the W on the left side. I think it might take 5, 6, 7 years to really set significantly new highs. Maybe that middle of the W because of QE goes a little higher because we don't get a collapse first, but it's going to be something jagged. I really can't see it not being, and I really hope I'm wrong. But as I've gotten better and better at this combination of more and more education and more experience and watching how the technical traders swing back and forth, and understanding that the fundamentals don't really support these valuations based on future outlooks. And the idea that private equity and the private markets have been absorbing so much of the economy the last decade that suddenly they're looking for exit liquidity and retirement plans, that scares the bejeepers out of me. Trying not to swear. So I'm going to use really old words that I think are fun. Although I don't think I'll get away from zucking. I think zucking is pretty funny. Any case, what do we do now? What do we do now? So I am going to write an options expiration update if I feel up to it after the call, and I will update all of my outstanding positions. So we have had quite a few things expire. My August $50 calls on AST Space Mobile must have expired because I didn't see the shares go away. Although I did make a trade today, check the chat. These expired. Closed this a while back. What else? Well, I should probably check. I think I may have had some NFE assigned to me. Where else do we have a few things? Those expired. And I'm going to have to double check. Those might have gotten called away. And those expired. So go ahead and take a look at your covered calls and cash secured puts that expired on Friday. See what assigned to you if you haven't already looked. What just expired. The trade I made this morning was to get defensive. I have some orders to sell cash secured puts on stocks that I sold. I sold those stocks because they were up roughly 10 times. And I think the combination of a choppy market and the fact that the space economy comes with speed bumps and the fact that a lot of the people that bid those stocks up have trader natures and they're younger. So if the moving averages roll over, they're going to get out. So I'm just trying to build a 20-ish % cushion so that if there is a correction, I won't be perfect on these trades and I will adjust the premiums that I'm looking for on the strikes that I'll put into the new article if the market really starts to take a dump, right? I will increase my premiums that I require to sell these particular puts. So I am going to probably leave the strike prices alone because I'd be happy if those particular trades come in, which I'll detail later on today, probably after a nap. And if prices go further down, and I want you to understand this about cash secured puts, you can lower your strike price or you can raise your premium. I'm going to raise the premium because I want those stocks assigned to me. If I was ambivalent about the stocks being assigned back to me, I would lower the strike price. But I'd rather have these stocks put to me. So I'm just going to try to finesse the most premium out of them as I can, which means that if a correction takes hold, I have to watch every single day, which I do. But I know a lot of you don't. But there are times when, if you're going to be managing your own money, you have to be on the dance floor. So while there's been a lot of time this year where you didn't have to do much, there have been a couple of periods where, at the start of the correction, at the end of the correction, when your options expired, you had to be pretty active for a few days at a crack. As volatility goes up, and you have to have a game plan for this, you can't just go in there and panic and say, oh, I got to do stuff. Have a game plan, but you have to watch every day when volatility goes up because the movements can be so fast and deep and then rebound that you may find a day out of 10 or out of 20 where you're like, holy cow, I need to execute a whole bunch of these trades. I need to change these so that they execute. So while we're using good till cancel orders, waiting for volatility to hit us, if volatility really is ramping up, you change your prices so that you don't sell your puts too early or buy your stock too early. Try to avoid the falling knives and pay attention to momentum. I've talked about momentum over and over again. You have to respect it. When moving averages start to collapse, when the 8 or 9 day or 10 day gets breached, depending on what people are using, Shooter uses the 8. I think most people use 10. A lot of people use 9. That's the first one to go. And then the 20 day, and then the 50 day, and then the 100 day, and then the 200 day. It's like dominoes. So you might see a single digit percentage of people sell when that first moving average gets breached. But a lot of people will sell, a lot more people will sell, especially hedge funds, when the 20 day gets breached. And then more people sell when the 50 day, and more people at the 100 day. And almost everybody sells when the 200 day gets breached. And then you get your market bottom, usually within 2 to 4 weeks of that. It could be 6 or 8 weeks, but you say 2 weeks, 2 months. And I'd say the way things are moving, probably closer to 2 weeks than 2 months. And once that 200 day is broken, you really start looking for things to buy after you've held your breath as long as you can. I'm going through this because I think this coaching is important. Again, I don't know if this market can hold out until the end of the year. It might because of the buybacks. But as companies continue to spend CapEx on AI and data centers, and if there isn't a resolution on energy because Russia somehow comes back into the fold, and that is the reason President Trump wants a resolution, it's because then Russian oil can get back on the market. We'll see how all these things play out. I am still pretty bearish on the first half of next year. So I like selling the cash secured puts versus owning stock because I think at a minimum, we're entering a choppy period and we might be entering a corrective period. So in a choppy period, my puts probably expire. I just get to put all that money in my pocket at those amazing internal rates of return on an annualized basis. And if the market drops, I start getting in at about 20% lower net. Sometimes 15, sometimes 25, but in that range. And then I have to wait to see when the momentum ends on the downside to get the rest of my capital deployed. I expect to be fully invested at some point next year, meaning 95% of my money in equities. Maybe 80 if I decide to load up on Bitcoin and gold. Bitcoin was a little bit weak this morning. It moves so fast, I have no idea what it's doing at this precise moment. I think the hype on Ethereum it's actually kind of laughable to me. Where were these people when we were buying in 2020 and 2021 at $400, $500, $600, $700, $800, $900 on Ethereum? Now they want us to buy Ethereum at whatever it is, $4,500, $4,800, whatever. That's the nature of the beast. So when things are on sale, people chronically are like, oh my God, it's just not going up and I hate the wait and look what it did. But after it doubles or triples or quadruples, I get questions. Should I buy it now? Should I buy it now? Should I buy it now? Readjust yourself if you think that you're in that camp, right? You need some cool hand Luke training. Get your mind right. Identify your top ideas. I'd say 50-ish of them, with the idea that you're trying to own 20-ish of them, because you're not going to get prices on all of them. And you want to rank order them as best you can, kind of in tiers, like I started doing with the dividend stocks last week. And I really think that you should be favoring mid caps the most. There are definitely grand slams to be made in small caps, and there's a little bit more certainty in some of the large caps, especially the mega caps. But the mid caps are the ones that are getting pulled by the S&P 500 magnet. So those mid caps, which are past the speculative might go out of business phase, they're in their high growth period. They're still closer to the bottom of the S curve than the top of the S curve. So you have a nice long ramp up of years. Those are the ones you focus on. So despite me selling all of my Rocket Lab and AST Space Mobile, all of it, I'm selling cash secured puts right away. And I will sell more cash secured puts or buy the stock on 10 and 20% corrections, because I don't have to be perfect, because I'm still buying in lower than where I sold. Right now, the mutual funds are pretty fully invested. I think they're the most fully invested they've been since 2006 or 7. There are a lot of things happening right now that are most or highest since 2006, 2007. Some things are as high as they were in 1999. So the idea that people are invested and saying that they're staying invested because they need to catch up, well, that's like saying, hey, I want to lean a little further over this cliff because I haven't seen the bottom. I just want to lean over a little bit more. When everybody's invested, who is it to push prices up? It's purely the index funds and the retirement plans, right? And what happens if unemployment goes up? So when there's very little cash on the sidelines and everybody says, but the money markets, yeah, the money markets aren't for the stock market. That's not where stock market money goes. Money markets are largely filled with family office money and international money. It is not mon pa. So the idea that there's trillions and trillions waiting to get into the stock market is so wrong. It's off the charts. Is there money waiting to come into the market? Sure, we're doing it. But if the mutual funds are fully invested and the hedge funds are starting to go short after getting beat up on their last short trade, just think about who is the exit liquidity. The exit liquidity are those last people that bought and the next people who buy. Valuations are at all-time highs, not seen since right before the financial crisis and right before the dot-com crash. There is no fundamental reason why that should be happening. And the only monetary reason is that we've printed more money and more money and more money through COVID. We've stopped doing that. Everybody says, oh, yeah, they print money. Yeah, they haven't printed money in 3.5 years. 3 years? 3 years. Almost 3.5. They've been unprinting money. Now they've been recycling it as fast as they could because they're not issuing very much long-term debt. It's all short-term debt. 2-3 years ago, Janet Yellen and the Fed, right, they started redoing the bonds at shorter and shorter durations, something that Scott Bessent has continued to do. So you have debt that was maturing over 10, 20, 30 years, starting to mature over 2, 3, 4, 5, 10, right, condensing the maturity schedule. And President Trump saying that he just wants to roll it every 90 days, which is why he wants the Fed funds rate lower. The problem with that is you still can only do it for a while. And if international investors say, well, we don't want to do that, who does it? They're going to have to force the Fed into doing it. So everybody wants to blame the Federal Reserve for the problems. You are looking past the culprit. Those Congress people who are pointing at the Fed and all the people who are minions of the Congress people and the rhetoric and propaganda machines, all pointing at the Fed, yeah, take a step back. Our debt problems, our currency debasement problems, our inflation problems are all the fault of Congress, and 5 different reconciliation bills that have happened since 1981. All of it, just about. And if you look at the data, it's easy to see. The national debt has gone up directly, 100% correlated to the increase in wealth of the richest 1% of people. It's stunning how that happens, huh? And the breathy defense of it by people who don't have much money is astounding to me. When people like Warren Buffett or littler guys like me tell you exactly how we're making our money And you just shake your head and say, well, it would be worse some other way. Fine. I'm just going to keep making money. And one of these days, like in 2008, 2009, when I was buying all the drinks and all the pizza and all the burgers and all the appetizers after the baseball games that I was playing with my friends, where I paid for them to join the team, where I was floating the entire bill, talking $6,000, $7,000, $8,000 a year back in 2008 and 9, when they were all broken out of work, telling me how things were broken and how everything worked. And then I picked up the tab and they said, yeah, I'm not really sure that you know what you're talking about, Kirk. I shrugged my shoulder. Both of them, actually, shoulders. Same thing's going on now, and it's even worse. The amount of money being stolen today through deregulation and tax policy and insider trading and buddy wink wink nod deals, they will teach classes on this. They will, unless we just completely get rid of education. So sometime in the next decade, some of these people will say, hey, and if you doubt that will happen, go look up Ronald Reagan's budget director, David Stockman. Look up David Stockman, read his book. Granted, his market prognostications haven't been right, but he does correctly ascertain how things started and where they've gone. The only thing that he hasn't been able to figure out, and it's because he's just not trained in it, is when does it all come down again? He kind of got the 2008 crisis right. I don't know if he made a good trade on it or not. But again, I've never been one to be particularly too concerned about the debt. I've always thought that the problems would manifest most, and those of you who have been with me for years know that I've said the same thing over and over again. When those last baby boomers get on the Social Security and Medicare, shit's going to hit the fan. Oh, yeah, sorry, sore. Well, we're getting closer. And this big skim that's going on right now, if you're not believing that it's happening, I don't know. I don't know how much more I can make the arguments. I get tired. So you can have FOMO about missing the next little up trade. And, I'm still participating. I'm selling a lot of cash secured puts, but I'm cautious. A couple of big wins have carried the day for me because a lot of my stuff has just been choppy and a few have lost. Again, I implore you, sell cash secured puts. Learn how to do it. Put the time and effort and energy into doing it. It'll be the best financial thing you've ever done because the premiums are high. The people on the other side of the trade are stupid, usually, or compelled to hedge because they can't sell for some reason. Those premiums are obnoxiously high, and I think they will be until into the 2030s sometime. In the 2030s, I think as the millennials mature and they start to trade less, more of them hire the guys like me just to manage their money, which is already starting to happen. Then the markets will become normalized and it'll be almost time to purely rely on asset allocation again. Things come full circle. Asset allocation has been less important lately and stock selection has been more important. And I think that flips at some point. I think just asset classes will become more important because I think it's inevitable. And I think these little Trump baby accounts are a harbinger. I think it is inevitable that we start putting Social Security money into the S&P 500 for sure, but it should be the S&P 1500. It should be the large caps, small caps, and mid caps. Proportionately, that's fine. Index funds, cheap. S&P, because it requires profitability, follow certain listing requirements. All right, a couple of questions up here. Should I get out of MP materials? I've doubled my money in 2 months. Well, I think that you can probably sell half or a third, depends how you look at it. Now, if we pull up a chart on MP, again, this is something that we talked about at $20 a share, and I did not pound the table on it as hard as I should have, and then it went nuts. I was looking at Coinbase. So, that's a heck of a move. Do you think the company was so undervalued here that this is the proper correction to the upside? Or do you think that it's overshot? Well, stretch out your chart. And understanding the history of MP Materials is kind of important. So the company used to be called Molycorp, kind of. That mine, the Mountain Pass mine, which is what MP stands for, was supposed to supply us with rare earth metals 15, 20 years ago. And they never put any money into the processing. And China stole the entire industry. What we should have done 20 years ago is we should have given 3 to 5 companies, loan guarantees to build rare earth processing and magnet making. And we didn't. With a loan guarantee, all you're doing is giving these companies some cheap financing, like they're doing with Ametis. That's what those USDA loans are. And in the case things don't work out, then the government picks it up. Well, you can see that the government's usually making bets, and they don't all work out, but they're usually making bets that have an aggregate benefit and are more likely to work out in time. They never did that with Molycorp. Well, now here we are. When did Molycorp go bankrupt? About 2012, something like that. Yeah, you can AI that. Make sure you read the footnotes. Don't just go because AI told me. Read the footnotes. Read the source material. Don't be lazy. Well, now we're giving them some loan guarantees and some contracts. So what is this company going to be worth? If you take a look at the value of the Chinese rare earth processing companies and what their revenues are, you will have a clue as to what MP Materials would be worth if it's a monopoly on this continent, which it will be for a little while, and then what it's worth in a duopoly or oligopoly. They're 5x. Is it a 5x or 10x? They're making their Texas plant way bigger. So what are they truly worth today versus what are they going to be worth? And think about this. What is MP going to be worth after EVs come back? Because they will. Again, not until we have an oil spike and everybody goes nuts, whenever that is. We know that U.S. oil is basically peaking right now, but it'll stay on that peak oil plateau 5 to 10 years. We also know that the technology for batteries is getting better. So somewhere in that 5 to 10 year window, EVs come back. They use all those batteries, rare earth metals. Technology is getting better, so they use a little bit less rare earth metals. Think about these moving parts. But 5 to 10 years out, MP Materials is probably at peak value. What will that be? Start reverse engineering the math, right? Reverse engineer the math. I think that you can buy the dips on MP, especially down around 50. And if we get an opportunity around 30, I think it's probably a no-brainer. These types of moves from about here to here usually give back about half or the whole thing. So we'll see. Does it stabilize in here or does it come all the way back down here to the red line? This line on these charts is auto drawn by the algo. Pretty neat, right? Pretty neat. That's why I don't even draw most of it myself anymore. There's no need. The programmed algos, you take a look at 7, 8, 9 of them, you go, okay, this is where the confluence is. This is where they overlap. This is about what's right. Take a look at your VWAP, right? Kind of keep an eye on bias, keep an eye on the different Wyckoff measures for accumulation and distribution. RSI is the easy shortcut, right? What does this tell you about what's going to happen next with MP Materials? What does that tell you? The weekly is very overbought. Now, does it come all the way down to here or does it jitterbug into here? I would say it probably jitterbugs into here. Unless the market breaks down altogether, then you could see it really sell off. And then it's a no-brainer down here. All right. That was your training for today. All right, everybody. I'm going to call it a day. I'm going to take a nap. All right, everybody. Have a fantastic day and eat your broccoli and fatty fish.